Hello, everybody. Welcome to Wiley Solution Walkthrough, Accounting Tools for Business Decision Making. Textbook authors are Paul Kimmel, Jerry Weingen, and Jill Mitchell. This is their 8th edition, and we're going to be doing a walkthrough today of exercises 1812, Tchaikovsky, and 1813. The question used in this presentation are copyright 2022 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. You can also use it to help you get to sleep. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within the presentation are mine and not the authors of the textbook or of Wiley. Okay. Before we say thank you to that bus driver, I got to come up with something new. We'll figure it out. Okay. So coming right over here, let's go ahead and take a look. So we've got in 2024, Manhoff Company had a break-even point of $350,000 based on a unit selling price of 5 and fixed costs of $112,000. In 2025, the unit selling price and the unit variable cost did not change, but the break-even point increased to 420. Oh boy, we got to do this question. Okay, so let's go ahead and take a look at this one right over here. So it says compute the unit variable cost and the contribution margin ratio for 2024. So let's just go ahead and check this out. So we're going to have a selling price. We have sales. Selling price is 5. And we have over here, so we've got units per unit total and less variable costs. And this is going to give us our contribution margin. Okay, and so then right over here, if we have fixed costs, our fixed costs are 112,000. Okay, so our net income basically is going to be 0. Okay, so here's where we are, right? So what I'm going to assume is what they mean by break-even point is the amount of sales. And I'm just going to take a quick break just to make sure that I'm right on that one. So what this is telling me is that right over here, this is going to have to be 350,000. Which means we must have sold. So what it means, like when they have break-even point, that's referring to the sales. So the units being sold should have been 70,000. So that means we would have variable costs for 70,000 units, and we would have a contribution margin for 70,000 units. So what this means to me is that in order to have a break-even of 0, we would need to have a contribution margin of 112,000. And why is that? Well, over here, our sales minus our variable costs gives us our contribution margin, which is our fixed cost. And if we're hitting break even, so this is going to be over here, be at 0. So by going through here and saying, well, what was the contribution margin per unit? I would take 112 divided by 70, and I'm going to get 1.60. That must mean then that the variable costs are going to be 3.4. So 5 minus 3.4 equals $1.60. Okay. So coming back over here, what I'm then going to go ahead and do is basically say, okay, this is going to be 238,000. Okay, for the variable costs. So compute the unit variable costs and the contribution margin ratio for 2024. So the variable costs are going to be 238. The contribution margin ratio is going to be right over here at, let's see, unit variable cost will be here at $3.40. What is the contribution margin ratio? It's going to be the contribution margin per unit divided by the sales price per unit. So right over here, my contribution margin per unit is 1.6. So my contribution margin ratio is going to be 1.6 divided by or 0.32. Okay, so then over here in 2025, the unit selling price and the unit variable cost did not change, but the break-even point increased to 420. All right. So right over here, let's go ahead and take a look. Okay. So tells me over here that my unit selling price, unit variable cost did not change. Okay, so what this means is that over here, but if my new break even is at, for my new break even, which is referring, I just don't know why they just call it total sales. So this would be 420 divided by 5. So we're going to have 84,000 units. And what does it say about fixed costs? Okay, so unit selling price did not change, but the break even point increased to 420. So what this means is that as we look at this over here, right, so the contribution margin is going to be 134,400. Okay, so let's take a step back again. My new sales are 420. My per unit is not changing. It's still at 5. That must mean I sold 84,000 units. If the variable costs are also the same as well, that means that the contribution margin is going to be the same. So that means my fixed cost to get to 0 must have increased to 134,400. Okay, and there we go. So the increase in fixed costs is going to be the difference between 134,400 and 112,000, or 22.4. Okay. So the increase in fixed costs is 22,400, and that is exercise 1812. Let's go ahead and go to exercise 1813. Billings Company have the following information available for September of 2025. The unit selling price of video game consoles is 400. The unit variable cost is 280. Fixed costs 540,000. Excuse me, 54,000. And then the unit sold is at 600. Let's set it up. So we got sales, variable costs. We have over here units. We have per unit. And then we're going to have our total. Okay, so our units sold are 600. Our per unit is 400. Variable costs are 280. That must be my contribution margin is going to be 120. So my total sales will be $240. My variable costs will be nice going Bennett. Okay, here we go. Okay, so that means me, I'm going to have a contribution margin of 600 units at 120, or 72,000, less my fixed costs. And then over here, this is then going to be 54,000. So it's going to be my net income, which is going to be right here at, wow, 18,000. Okay. So compute the unit contribution margin. So my unit contribution margin, or my contribution margin per unit, is going to be 120. Okay, so that's going to be 120. Prepare a cost, volume, profit, income statement. Include columns for per unit and percentage of sales information. I have no idea what that means. Percentage of sales? Oh, really? What they're asking for here is they're basically saying, okay, 240 divided by 240,000 is 100%. This divided by 240 is going to be 70%. So this must mean that the contribution margin is going to be at 30%. I don't know why you would go through and do that. Okay. And now compute billings break-even point in sales units. So let's go ahead right over here. So my break-even point in units is going to be my right over here, my fixed costs. My fixed costs are 54,000. My contribution margin per unit is 120. So when we look at this right over here, we've got 54,000 divided by 120 or 450. To make sure that this works, and remember, we always need to make sure that it works. If I put 450 on each one of these over here, I'm now at 0. So again, you always want to test it going through. And again, is this really going to go through and change? The answer is probably going to be no, because this is still as a percentage of sales, break-even point, and then per unit and percentage of sales. So I think we should be good. Yeah, I think that's what it is. Okay, so that is exercise 1813. Very exciting. So I want to thank all of you for being here, and thank Wiley most of all. Again, I really appreciate Wiley allowing me to go through and to use their questions for these videos. And if you please don't forget to like and subscribe. And if you want to see other solutions, feel free to ask for them in the comments. Have a great day.